Hello, and thank you for attending our presentation today, a CPA's Guide to Household Employment Compliance. My name is Trevor Sparks with GTM Payroll Services, and we appreciate the time you're able to spend with us today. A couple of housekeeping notes before we get started. If you have any questions, please use the questions functionality in the presentation console to submit them. We'll answer as many questions as we can during the presentation. If we don't get to your question, we'll follow up with you within the next day, and you'll receive an email after the presentation with a link to download the slides from this presentation, as well as a video recording. During today's presentation, we'll ask you 4 questions. You must answer at least 3 questions to receive CPE credit. As a reminder, this course is 1 CPE credit hour. If you successfully complete the course, we'll email you this certificate of completion within 5 business days. Here's an overview of what we'll go over today. We'll discuss the basics of when someone is the employer, what happens as an employer, what obligations the employer has, what risks the employer has, what insurance is required, what's been happening with household employment and what's new this year, including paid leave laws, rising minimum wage rates, and labor compliance regulations, and how to convey the importance of compliance to your clients when saying it's the law just isn't enough. At the end of this presentation, you'll understand your client's household employment tax responsibilities and how to manage them, new labor laws that are impacting household employment, and what's new this year in household employment tax compliance, and how to explain the benefits of compliance to your clients, as well as the costly downside if they're caught not following the law. And at this point, I'd like to turn it over to our presenter today, Michael Trucolo. Mike.
Thank you, Trevor. So before we get into what's new, I'd like to take a step back and just look at the basics of household employment, starting with who is a household employer and who are domestic employees. For the most part, it is a family hiring a nanny to look after their children in the family's home. But we're also seeing more and more senior caregivers hired to help elderly loved ones age in place, as well as nanny shares, where one nanny cares for the children of multiple families in one of the family's homes. They've grown in popularity as an alternative to daycare centers. We've come a long way since 1993, when President Clinton's nominee for Attorney General, Zoe Baird, was removed from consideration for the job because she and her husband had broke the law by employing 2 illegal aliens to nanny and chauffeur their child and failed to pay employment taxes. That prompted Congress to change the way household employment taxes are filed and to create the Schedule H, which shifted nanny taxes onto Form 1040. So we typically think of a household employee as a nanny, but anyone who works in someone else's home could be considered an employee. As we mentioned, senior care is a growing workforce. If your client privately hires a senior caregiver, either for themselves or an elderly loved one like a parent, instead of going through a home health care agency, that worker could be considered an employee of the senior or the family. Another area you may not think of is seasonal or temporary childcare. A babysitter with regular hours, a nanny hired just for the summer, or an after-school nanny can easily earn enough for household employment taxes to kick in. Other household employees may include personal assistants, housekeepers, chefs, chauffeurs, or any other estate staff and nanny shares. When a family hires a nanny, it's straightforward who the employer is. But I just want to point out that there are a couple of additional wrinkles when hiring senior care. Your clients have a few options for finding senior care. How they bring the in-home caregiver on board will determine whether they are now employers. A home healthcare agency will employ the caregiver to work in the senior's home, pay the employee, file taxes, and comply with tax, wage, and labor laws. In this case, the agency controls the job duties of the employee. The agency will select the caregiver and send them to the senior's home. However, the senior is not always going to get the same caregiver. The agency is the caregiver's employer, so they control employment. A referral or placement agency recruits the senior care worker on behalf of the family. They charge a fee for this service and then hand over control of employment to the family, which is then responsible for payroll, taxes, insurance, and compliance. The caregiver is an employee of the senior or their family. and this would be similar to a family hiring a nanny through a nanny agency. So by doing it themselves, a family finds, recruits, and hires the senior care worker without the assistance of an agency. The family will also handle payroll, taxes, insurance, and compliance. So this caregiver is an employee of the senior or their family. A family may try to avoid household employment taxes by classifying their worker as an independent contractor. That way, they can give them a 1099 at the end of the year, and the employee pays the entire tax obligation. An independent contractor pays both the employer and employee FICA tax obligation, which is 15.3% of cash wages. And the family also avoids unemployment taxes and other responsibilities such as workers' comp insurance. However, the IRS almost always classifies household workers as employees and not independent contractors. So that's not going to work, and here's why. It comes down to a matter of control. So a family sets their employee's schedule, tells the employee how to do their job, and the employee uses the family's tools and equipment. For example, a family with a nanny says your work hours are Monday through Friday, 8 a.m. to 6 p.m. The baby takes a nap at this time and is fed at these times. The nanny uses the family's stroller for walks and their kitchen to prepare food. The nanny is not going to determine when they'll work, and they're not going to make up a baby's sleeping and eating schedule. So in this case, the family is in control of the employment, and the nanny is their employee. If you ever have any doubt, you can file Form SS8 with the IRS and have the IRS decide on the worker status. Just understand that employee misclassification is considered felony tax evasion. All right, Trevor, let's go to our first poll question.
Okay, thanks, Mike. Our first poll question is on everyone's screen. Which of the following affects whether a domestic worker is classified as an employee or an independent contractor? Just answer right there on your screen, A, B, C, or D. This is one of the 4 questions we'll ask during the presentation today. You'll need to answer 3 of them. You don't have to be right, but you just have to answer them, and you'll be eligible for CPE credit. If you have questions about the content of the presentation, feel free to submit those in the questions module of the presentation console, and we'll get to as many questions as we can at the end of the presentation. You'll also see that you can download some materials, including a PDF of the presentation, which will also be in a follow-up email when we're done here today, and you also get a link to the video recording. So. Looks like we have everybody in, and the answer here is D, all of the above. Okay, Mike, I'm turning it back to you.
Thank you, Trevor. So, one of the first steps to understanding nanny taxes is determining whether the employee's wages have met or exceeded the employment coverage threshold for domestic workers. This is commonly called the nanny tax threshold. There's no coverage threshold for most industries, so every dollar of wages is covered and taxable. Household employment is one of the industries with an employment coverage threshold. The Social Security Administration sets this amount every year, and for household employees, it changes with the National Average Wage Index. The threshold for wages earned this year is $2,800. Last year's threshold was $2,700. Use the 2024 threshold if you're filing a client's tax return for the October 15th extension deadline. We should know the 2026 threshold by next month. So you can see how easy it is for even a temporary or a seasonal worker, such as a summer or after-school nanny, to exceed that threshold and trigger nanny tax compliance. If a family goes over that wage threshold, they'll need to withhold and pay Social Security and Medicare taxes, which are commonly called FICA taxes. That total is 15.3% of cash wages, which is split evenly between the employer and employee, with each contributing 7.65%. Employers can choose to pay their employee's share and not withhold it. Keep in mind that taxes paid to cover an employee's share of FICA must be included in their wages for income tax purposes. They aren't counted as Social Security and Medicare wages or as federal unemployment wages. You can report the Social Security and Medicare taxes paid in boxes 4 and 6 of the employee's W-2 form and add the taxes to the employee's wages reported in box 1 of the W-2. Make sure not to count wages that are paid to a spouse, a child under the age of 21, a parent, or any employee under the age of 18. For unemployment taxes, if cash wages to an employee is $1,000 or more in any calendar quarter, then the employer pays federal unemployment tax. That's 6% of cash wages on the first $7,000 of cash wages. An employer may also owe state unemployment taxes. They may be able to take a credit against their federal unemployment tax if they pay state unemployment. It could be as much as 5.4%, which will really reduce the amount owed for federal unemployment. For unemployment taxes, the exclusions are spouses, children under the age of 21, or parents. So just to review a couple of key points, the household employment tax responsibilities kick in when the $2,800 in cash wage threshold for 2025 is met, or $2,700 for 2024 wages. The family pays 7.65% of their employees' pay in FICA taxes, and they also pay federal and state unemployment taxes if applicable. For the employee, they'll also owe 7.65% of their pay. This is required to be withheld and remitted by the family. Again, the family can choose to pay this on their employee's behalf instead. Either way, the employer is responsible for remitting the employee's portion of FICA taxes. Federal income tax does not need to be withheld, and it's only if the family wants to. However, it's always a good idea to withhold so that the employee is not stuck with their entire income tax bill at the end of the year. If a family decides to withhold income tax, they'll need to provide their employee with a Form W-4 and a state withholding form. These are going to determine how much to withhold from the employee's pay for income taxes. State and local taxes, if applicable, will obviously vary depending on where the employee lives. So we know what is owed, but how are these taxes remitted? So there are two ways that you can go about this. The first way is probably the best way to do it. Remit household employment taxes quarterly using Form 1040 ES, then detail the annual amounts paid on the Schedule H. If your client prefers, they could increase withholdings from their own pay to anticipate this increase to cover their household employment taxes. You should do one or the other. If the nanny tax obligation is large enough, your client may wind up owing taxes when they file and possibly be subjected to an estimated tax penalty and interest for underpaying taxes during the year. And with that, I will turn it to you, Trevor, for our second poll question.
Okay, thanks, Mike. Our second poll question is on everyone's screen. True-false question here. An employer can choose to pay the employee Social Security and Medicare tax responsibility. Just answer right there on your screen. So this is our second of four poll questions for CPE credit. Answer 3 of these questions and you're eligible for CPE credit, and we'll get those certificates out to those probably either by the end of the week or early next week to those who qualify for CPE credit. And if you have any questions on any of the material we're covering, please use the questions box in the webinar console, and we'll get to as many questions as we can at the end. Looks like we have everybody in, and the answer here is true. The employer can pay the employee Social Security and Medicare tax responsibility. All right, Mike, turning it back to you.
All right, so let's talk paperwork. So here are some of the forms needed as a household employer. The SS4 is to apply for an EIN, and that can be done online as well. The family will also need to be set up as an employer with their state and file a new hire report. They'll also need to obtain a Form I-9 from their employee, which we'll get into more in a moment. If they decide to withhold income taxes, they'll also need to obtain a Form W-4 and a state withholding form from their employees. So a little bit more about the I-9 form. Families with household help must collect the I-9 from their workers at the start of their employment. And this is something we've all filled out in the past when we've started a new job, and it's no different for nannies, housekeepers, and senior caregivers. As a reminder, the I-9 confirms a worker's identity and authorization to work in the United States. They can submit a document from List A to prove their identity and employment authorization, or documents from List B and List C. Form I-9 must be signed no later than the first day of employment, and documents must be presented within 3 business days from the start of employment. A family needs to inspect the documents, make copies, and return the originals to their employee. The documents must reasonably appear to be genuine and relate to the employee. Copies of the documents are kept in the employee's personnel file with the I-9 form, and they are not returned to any government agency. Employers should retain the I-9 form for either 3 years after the date of hire or for 1 year after employment is terminated, whichever date comes later. The I-9 form can be completed electronically to help reduce errors as well. It is available on the U.S. Citizenship and Immigration Services website at uscis.gov. So at year end, the employee needs to receive their W-2 by January 31st. Also, Form W-3 and Copy A of W-2 must be submitted to the Social Security Administration by that same date. And then the Schedule H is filed with the employer's personal tax return. So what we've covered so far is basic tax withholding responsibilities. Now we'll get into some of the labor, tax, and payroll nuances surrounding household employment. Some of these are state specific, such as a domestic workers' bill of rights. There are also rules around overtime pay, live-in workers, sleep time, and companionship care. And in a growing trend, many states and cities have paid leave requirements that are impacting household employers. So what is a domestic workers' bill of rights? These laws bundle domestic worker protections, which could include minimum wage, overtime pay, paid time off, days of rest, and more. In New York, for example, household employers must give 1 day of rest for every 7 days and provide written policies on sick leave, vacation, and work hours. They must also provide 3 paid days off after a year of work. They must pay on a weekly basis and need to provide a pay stub, even if the employee is paid electronically or by direct deposit. Massachusetts is similar, and there are protections for mandated amount of rest time depending on hours worked, written work agreements, and more. If you have clients with household employees in any of the states or cities with domestic worker protections, you'll want to familiarize yourself with these obligations. The first Domestic Workers Bill of Rights took effect in New York in 2010, and since then, several other states and the cities of Chicago, Philadelphia, Seattle, and Washington, D.C. have enacted similar laws to grant basic labor protections to household employees. As a heads up, domestic worker protection legislation is working its way through the state legislature in Washington, so we're keeping a close eye on that. You'll hear us say this frequently during the presentation, but non-compliance is costly. Here's just one example from New York. If your client violates the state's Domestic Workers Bill of Rights, which requires weekly pay for household employees, they could be sued for up to 300% of delayed wages, plus attorney fees and interest. So again, it's important to review the domestic worker protections in your state and city. The FLSA, which stands for the Fair Labor Standards Act, includes household employees. Domestic workers must be paid at least the applicable minimum wage rate. The federal minimum wage is $7.25 an hour, and that hasn't changed for quite some time. However, many states, counties, and cities have enacted higher minimum wage rates than the federal rate. In California, for example, the minimum wage is $16.50 an hour, which supersedes the federal rate and becomes the applicable rate. However, dozens of cities in California have higher rates than the state rate. Los Angeles is now $17.87 an hour, and San Francisco is $19.18 an hour. So those local rates would apply. And just to make it even trickier, many states have built-in increases to their minimum wage rates. You'll need to pay attention to this because if your client is paying their employee minimum wage or close to it, because their hourly rate can quickly violate that wage law. So according to the FLSA, household employees are non-exempt workers. That means they must be paid hourly rather than a fixed salary. This also means household employees get time and a half in overtime for hours worked over 40 in a 7-day work week. Live-in employees and caregivers who meet the companionship care definition may be exempt from overtime, and we'll get more into those situations in a moment. California is a little bit different. Time and a half kicks in after 8 hours a day, 40 hours a week, and the first 8 hours worked on the 7th consecutive day of work in that work week. Your clients with household help should maintain records of hours worked and pay to ensure that they are meeting minimum wage and overtime rules. And this is where many household employers get into trouble. They'll forget to track hours and pay, and they wind up getting sued by disgruntled employees who seek back wages because they weren't paid properly. So, live-in employees. You'll see this a lot with nannies or seniors who need around-the-clock care. Up to 8 hours of sleep time can be unpaid if certain criteria are met, and 5 hours of continuous sleep is a big one. If a live-in nanny is expected to be on call during the night and their sleep time is interrupted to care for a child, even just for a few minutes, and they don't get at least 5 hours of uninterrupted sleep, then the entire 8 hours of sleep time is now paid. The exception to this is California, which doesn't allow sleep time to be unpaid. As for overtime, federal law exempts live-in employees from overtime pay. However, some states, like New York, have their own overtime requirements for live-in employees, and those supersede federal law. In Minnesota, overtime for live-in employees starts at 48 hours, and Oregon, like New York, is 44 hours. In Hawaii and Maryland, live-in employees need to be paid overtime for hours over 40, so they're not excluded from overtime laws in those states. So, companionship care. This is a key consideration in senior care. If a caregiver falls into the companionship care exemption, then they do not need to be paid overtime for hours worked over 40 in a work week. If they don't have the exemption, then they do need to be paid for overtime. Work is defined as things necessary to care for an elderly patient. Bathing or dressing the patient, cleaning, and cooking are some of those activities. Only 20% of a caregiver's work time can be spent doing these sorts of activities in order to qualify for the exemption. That means the rest of their time is spent with fellowship and protection. They can be watching TV, doing puzzles, playing cards, or doing whatever it is that is not necessary for the care of an elderly patient. It's also important to know that the exemption doesn't apply to caregivers hired through a third party. So, if a family thinks they can take advantage of the companionship care exemption, hiring privately and not going through a third party could be of a big financial benefit. There's a growing trend for paid family and medical leave at the state level now, and many of these programs include household employers. There are more than a dozen states with laws requiring paid leave, and we've listed several of them here. California, Colorado, Connecticut, Illinois, Massachusetts, Michigan, Minnesota, New Jersey, New York, Oregon, and Washington State are all active, meaning household employees, if eligible, can take leave for qualified reasons. A couple to keep in mind if you have clients in these states: contributions to Maryland family and medical leave have been delayed. Payroll deductions will now start in January of 2027, with benefits available the following year. In Minnesota, contributions to its paid family and medical leave program start in January of 2026. However, employers must submit quarterly wage reports to the state for PFML purposes starting October 31st and provide written notice to employees by December 1st. And in Alaska, the paid sick leave requirement started in July. Localities such as New York City, Chicago, Pittsburgh, and Washington, D.C. all have paid leave requirements as well. On January 1st, Pittsburgh's Paid Sick Days Act will increase the number of paid leave hours available to household employees from 24 to 48 hours a year. Paid leave laws often include all employers, even those with just one employee, like a family with a senior caregiver or a nanny. These programs may require a small employee contribution through a payroll deduction, or your client can cover that contribution for their employee. So it's important to look at any paid leave laws in your state and determine if it applies to the household employers. If they do, you'll need to follow the rules around contributions if they're required. So we mentioned earlier that families may try to classify their employees as independent contractors to avoid their tax obligations. Another way to avoid their responsibilities is to put a nanny or senior caregiver on company payroll, and this won't fly with the IRS either. It's considered an illegal tax deduction because all employees on business payroll must directly contribute to the business's success. And of course, there is an exception. A sole proprietor of a business or farm with household employees can report their household payroll taxes on their company's Form 941 or Form 943 for farmers for ease of filing. That doesn't mean that they can put their household worker on their business payroll. It just means they can report taxes on the 941 or 943 forms. Even with this exception, and to keep it simple, it may be best to keep household payroll taxes separate from business-related taxes. File Schedule H for household and file Form 941 for business or Form 943 if that business is a farm. Outside of that one exception, do not use the Form 941. Using the 941 and not a Schedule H is a common way that accountants may handle household payroll taxes and make mistakes when reporting household employment taxes. This misstep can make more work for you, increase the risk of penalties, cause dual reporting to the IRS, and create other accounting issues. The Schedule H was created specifically for household employers to report wages paid to employees during that year. It's an annual filing that's prepared with your client's personal income tax return. Form 941, however, is filed every quarter, even if your client didn't pay an employee during that period. If you fail to file the 941, even if there was no payroll to report, your client will incur penalties. You should keep copies of the Schedule H and other employment tax forms filed, as well as Forms W-2, W-3, and W-4. For unemployment tax purposes, you should retain total amount of employee compensation, amounts subject to unemployment tax, and state unemployment contributions. Keep payroll and tax records for at least 4 years after the due date of the return on which you report taxes or the date the taxes were paid, whichever one comes later. Unemployment tax records should also be retained for 4 years after their due date or the date the unemployment tax was paid, again, whichever one is later. Most states have a 2-year statute of limitations on lawsuits filed by former employees, so keep documentation for at least that time period. For auditing purposes, you may want to maintain tax and payroll records for up to 7 years. In any case, it's always a good idea to maintain employee tax and payroll records for longer than you think you may need them. So those are the basics when it comes to tax, wage, and labor laws for household employment. I also want to highlight liability insurance, as this can be one of the costliest mistakes a household employer can make and an easy way for a family to get caught if they're not paying their employee on the books. You never know when an injury might occur, whether it's around the house, driving the kids in the car, or walking the dog. Unforeseen risks are always in play. Household employers in many states are required to carry workers' compensation insurance for employees who get hurt or sick on the job. This will help pay for a worker's medical expenses and lost wages. Without the required coverage, a family could face thousands of dollars in fines and penalties and a possible lawsuit to recoup lost wages and pay medical expenses. So even if workers' compensation is not required, it may be wise to get a voluntary coverage put in place. So who benefits from workers' compensation? Both the employee and the employer are protected by workers' comp. Some of the employee's medical bills and lost wages will be covered, and employers are very likely to avoid a lawsuit. This kind of protection can easily be worth tens of thousands of dollars for your high net worth clients. A popular question we get here at GTM when the topic of workers' comp comes up: doesn't my homeowner insurance cover this? The short answer is no. There's a difference between someone visiting your home, slipping and falling, or even a worker such as a plumber or an electrician getting injured while working in your home, versus having somebody employed in your home for 20, 30, 40, or even 50 hours a week. Never assume that an employee is covered under homeowners insurance. The exceptions for this are New Jersey and California. In New Jersey, you can add a rider for your workers' compensation to your homeowner's policy, which is substantially cheaper than a standalone policy. And in California, it's required to have workers' compensation on your homeowner's policy if you have a household employee. This is what we mean by not having the required workers' comp is one of the costliest mistakes a household employer can make. Fines can be as high as $5,000 every 10 days of noncompliance, which is $15,000 a month. It's not uncommon for fines to quickly reach tens of thousands of dollars. The GTM Insurance Agency, which is an affiliate of GTM Payroll, will receive calls when a family is looking to get coverage because they just got caught not having a policy or their employee got hurt. Once, a family came to us after getting a $120,000 fine for not having the required coverage in place. So again, looking at the workers' comp rules in your state is extremely important. We've listed the states where it's required for full-time, part-time, and full-time only workers. So how does somebody get caught? This happened in Connecticut to a family that was paying their nanny off the books. Their nanny fell down the stairs while carrying a baby, and the baby was okay, but the nanny had injured her back. She went to the hospital, and the doctor asked, "How did this happen?" The nanny responded, "Well, I was working." So it became a workers' compensation case, even unintentionally. The nanny missed several weeks of work. She expected her medical bills to be paid and to receive her typical pay while she recovered. The family didn't want to pay her because they were already paying another caregiver to cover for that injured nanny. So a couple of things happened here. The family was exposed for paying their nanny illegally. And why? Because they didn't have workers' compensation. They dealt with back taxes owed, plus fines and penalties on those back taxes. And they dealt with fines for not having workers' comp in place, which in Connecticut is $300 a day for every day without coverage. So you can see how quickly that adds up. On top of that, the family paid the family paid the employee's medical bills, lost wages, and a fill-in nanny, and needed to find another employee as they had damaged the relationship with their existing nanny. And on that note, I will turn it to you, Trevor, for our third poll question.
Okay, thanks, Mike. Our third poll question should be on everyone's screen. Workers' compensation insurance protects employers from which of the following risks? You can answer right there on your screen, A, B, C, or D. So this is our third poll question. We have one more to go. If you answer 3 of our poll questions, you'll be eligible for CPE credit, and we'll get those certificates out by the end of the week or early next week to those who qualified for CPE credit. We're coming close to the end of our formal presentation, so if you have any questions for us on the material we've covered, feel free to submit a question in the question module in the webinar console, and we'll get to those at the end of the presentation. We'll also share Mike's contact information at the end as well, so if any questions come up after our time here, feel free to contact him with those questions. You'll also receive an email after the presentation that will have a link to download the presentation as a PDF and a link to watch this as a video recording. We also have a survey to take as well, so if you can take just a couple of moments to answer 5 quick questions about the presentation today, we would appreciate that as well. All right, looks like we have everybody in. The answer here is D. Both A and C will protect your clients from household employment risks. All right, Mike, back to you.
Thank you, Trevor. Okay, so now let's look at some updates in the household employment industry. The tax reporting rule for mobile payments is now being phased in. Employees would have received 1099-K forms this past tax season if last year's reporting criteria of $5,000 in transactions was met. The threshold will be lowered to $2,500 this year before reaching the statutory level in 2026. The reporting rule may change how your clients pay their nannies and babysitters. Payments for goods and services, like babysitting or childcare, through third-party settlement organizations such as Venmo, PayPal, and Cash App were reported to the IRS if those transactions totaled $5,000 or more. The intent of the requirement is aimed at businesses that use these apps to get around banks and traditional forms of reporting income. The IRS wants to make more transactions reportable, so it's harder for businesses to underreport their taxable income. Unfortunately, with all of this, household employers are getting swept up in it as well. Families that employ full or part-time household help, such as nannies, in-home senior caregivers, and housekeepers, may want to avoid using mobile payment platforms to pay their workers, as those workers will likely get a 1099-K from the IRS as well as a W-2 from their family, which can cause some confusion. Paying a date night or occasional babysitter through a mobile app may still be acceptable, but those sitters should know that this income will likely be reported to the IRS and should be reported on their personal tax return. It's always been a requirement to report income when the net earnings from self-employment exceed $400. This new rule just broadens the reporting of tax information to the IRS. And remember, this is not a new tax, it's a new reporting requirement. A seemingly easy way to circumvent the new rules may be to pay for a babysitter services in a personal transaction, as if they were a family member or a friend. However, if you pay a babysitter on a regular basis, those consistent transactions will raise red flags with the payment platform and call into question whether those payments were truly made to a family member or friend. In fact, PayPal, which now also owns Venmo, says it will monitor accounts to ensure that personal payments are not being used for sales of goods and services. It's always best to pay a babysitter as a service transaction. A best practice would be to pay a full-time nanny or employee by direct deposit or by check. Here are the contribution limits for certain employee benefits for the 2025 tax year. Contributions are made on a pre-tax basis, which can reduce the amount your client and their employee owe in taxes. Plus, offering benefits is a great way for your client to retain top workers and attract the best candidates. Here are some of the key contribution limits relevant to household employment. So I just want to highlight the QSEHRA, which stands for Qualified Small Employer Health Reimbursement Account. This can help an employee reduce their healthcare costs tax-free. This is for employers with less than 50 employees, as long as they don't already offer a group health insurance plan. So perfect for families with household help. Employees are reimbursed for health insurance coverage purchased on the individual market or through the healthcare exchange, and for out-of-pocket medical, dental, and vision expenses. These QSERAs are funded by the employer, and these contributions are not taxed for the employer or the employee. Reimbursements are also not taxed as long as the employee has a health plan that meets minimum essential coverage. For 2026, the maximum annual contribution for a dependent care FSA will increase to $7,500 per household, or $3,750 for those married filing separately. This change was part of the One Big Beautiful Bill Act, which provides a permanent but not inflation index increase to the contribution limit for the first time since 1986. A dependent care FSA, sometimes referred to as a dependent care assistance plan or DCAP, is a pre-tax benefit account offered by employers and used to pay for qualified, out-of-pocket dependent care expenses, such as a nanny's wages. By putting money into that dependent care FSA, your client will reduce their overall tax obligations as funds are withdrawn from their pay and placed into their account before taxes are deducted. It lowers their taxable income, both for income and FICA taxes, so your clients end up paying less in taxes overall. As we've discussed, household employees are required to be paid the highest applicable minimum wage on a federal, state, and local rate. State and local rates have been on the rise. Many states and cities are making annual incremental increases until they hit $15 an hour or more. This is just a sampling of states and other jurisdictions that are popular for household employment and increase their minimum wage rates on July 1st. A number of states and cities have already announced their minimum rate increases for 2026 as well. This is not exhaustive, but it just gives you an idea. Clients are paying minimum wage or close to it should keep an eye on these rate increases, as their employees' pay rate can quickly become a wage violation. Some new and upcoming paid leave programs have requirements to be aware of. In Minnesota, the first quarterly wage detail reports are due on October 31st. These reports must detail the wages paid to your employees between July 1st and September 30th of this year. You'll submit this information using the existing state unemployment insurance system. The quarterly wage detail reports submitted for paid leave are identical to the wage detail reports employers currently submit for unemployment insurance purposes. And then, on January 1st, employers can begin deducting the employee share of paid leave. As mentioned earlier, Maryland has delayed the implementation of its family and medical leave insurance program. Payroll deductions won't begin until January of 2027, with benefits for employees starting no later than a year after. A couple of significant changes to Pittsburgh's Paid Sick Days Act will affect household employers. Starting January 1st, the amount of paid leave available to employees doubles from 24 to 48 hours, and they will accrue paid leave at a faster rate. In Maine, benefits for household employees are now available under that state's paid family and medical leave program. So I'd like to wrap up with some of the benefits of being compliant. So we've already talked about the first three benefits on this list. It's lowering your risk and avoiding trouble with the IRS, workers' compensation boards, and disgruntled employees. A client can also take advantage of those tax breaks, which may be more than their nanny tax obligation. For an employee, they'll have a legal employment record and verifiable income, which helps with getting a loan, a mortgage, or a line of credit. If a nanny wants to buy a home or a car, it's better that they're paid legally. They can also get unemployment benefits if they are let go through no fault of their own. They're also protected by workers' compensation if they're injured on the job, and in states with disability insurance requirements, they're protected for injuries outside of work as well. With senior care, you can look to reduce costs through long-term care insurance and veterans benefits. To take advantage, you may need to provide payroll information and caregiver activity logs. So in this case, the caregiver needs to be paid legally. Your client may be able to deduct expenses they paid during the year for medical and dental care for themselves, their spouses, and their dependents. IRS Publication 502 has more details on this. With a medical care or healthcare FSA offered through your client's employer, they may be able to pay their elderly loved one's medical expenses that aren't covered by insurance. That senior must qualify as their dependent. If the person receiving care lives with your client, is physically and mentally unable to care for themselves, and requires a caregiver to care for them so that your client can work, then your client may be able to pay some of their seniors' care expenses through Dependent Care FSA offered through their employer. The senior may also be a qualifying individual under the Child and Dependent Care Tax Credit. The senior must be physically or mentally incapable of self-care, have lived with your client for more than half of the year, and be either their dependent or could have been their dependent under certain exceptions. These are potential options for your client to reduce their tax obligation and reduce their costs as a household employer. And now, Trevor, I will turn it to you for our final poll question.
Okay, Mike, our final poll question is up. What are the benefits of being compliant with domestic payroll laws and regulations? So as usual, just answer right there on your screen, A, B, C, or D. This is our final poll question. So if you've answered at least 3 of our 4 questions, you'll be eligible for CPE credit, and we'll get those certificates out to everyone by the end of the week or first thing next week, and you'll have those. Look out for an email after our presentation. I'll have a link to download the presentation as a PDF as well as a video recording, and a brief survey if you can take that as well. That's helpful for us. 5 quick questions about our time together today. If you have any questions for us, please use the questions module in the webinar console. Submit any questions you have on the material we've been covering, and we'll try to get to as many questions as we can before our time is up. If we don't get to your question, we'll be sure to follow up with you, and we'll also share Mike's contact information, so you'll be able to use him as a resource after today, and any questions you have about household employment, you can get in touch with him. All right, looks like we have everybody in, and the answer here is D, all of the above. All right, Mike, back to you.
Thanks, Trevor. So if you have a client with a household employee, these are the steps you or they need to take to be compliant. They must file federal and state unemployment taxes every quarter and prepare W-2s, W-3s, and a Schedule H at the end of the year. The last point here could be the most important. Tax, wage, and labor laws are constantly changing. We talked about paid leave laws, minimum wage rates, and domestic workers protections, and more are coming. So it's important to monitor changes in the law that may impact your clients with household help. Don't procrastinate. We can't emphasize this enough. Household employment compliance is not something you'll want to handle at tax time. You have enough going on, and you don't need a client to tell you in January that they hired a nanny the previous year but haven't been withholding taxes. You'll then need to track down hours and wage information to make sure minimum wage and overtime rules have been followed. And that's the last thing you'll want to be doing during your busiest time of year. It's much better to get on top of this at the time of hire. Also, as a reminder, workers' compensation needs to be in place before the employee starts work. And again, those fines are daily, so it's important to get them set up beforehand. So here's a list of resources available, including publication 926, which is essentially the IRS Bible regarding household employment. We discussed using Form SS8 if you want the IRS to tell your client that their nanny is an employee and not an independent contractor. And Form W4 is needed if your client plans to withhold income taxes from their employee's pay. So I'd like to thank you for attending our presentation today, and I hope you found it valuable. We may have some time for a few questions now, but if anything comes up while you're handling nanny taxes or household payroll, please don't hesitate to contact us. We are more than happy to help. So on to the questions, Trevor. What do we have?
All right, Mike, thanks. The first question up here, what about a part-time household employee like a nanny hired for after-school childcare?
Sure. So this is the time of year where parents plan for after school care for their children, and some may hire a temporary nanny, but the same rules will apply. Once a nanny, even a temporary one, hits that 2,800 threshold, nanny taxes do kick in. And that threshold, it can be hit pretty easily. If they're making $20 an hour for a 20-hour work week, they'll be over the threshold within a couple of months. So you definitely want to check in with clients, even if they've only hired temporary or part-time help for the school year.
All right. Mike, our next question, are there any problems when an employer doesn't give a W-2 to their employee?
So the employee, they're going to need that W-2 to file their personal tax return. If they tell the IRS that they didn't get one, your client will immediately get a call from the IRS. We don't have to tell you that it's good to avoid those kinds of calls.
That's true. All right, our next question here. How do you structure payroll and taxes for a live-in nanny and nanny shares?
Sure. So we'll start with the live-in nannies. We've touched on overtime and sleep time for live-ins. Many of the same domestic workers protections we've discussed will also apply to live-in nannies. A family can exclude the cost of room and board from their nanny's pay as long as meals and housing are provided in the family's home for the family's convenience. However, the nanny's rate of pay after those deductions must still be at or above the prevailing minimum wage. Also, a family may also be deemed a landlord if they take room and board out of the employee's wages because now the nanny is considered to be paying rent. So the family will also need a landlord-tenant agreement with their nanny contract. And in some states like Massachusetts, you aren't allowed to deduct costs of housing from your nanny's pay if that job requires them to live in your house. As for nanny shares, each family in a nanny share is considered to be a separate employer. So there's going to be separate tax IDs, separate workers' compensation policies, as well as other policies or anything going into household employment. Both families are going to need to pay at or above minimum wage and an overtime rate, and the nanny should be receiving 2 paychecks on payday.
All right, thanks, Mike, for that. Our next question is, what are the potential penalties if a client is audited and they had a household employee that wasn't set up correctly as a W-2 employee?
So there can be fines at a state and federal level for this. Those fines are left to the agency's discretion, so it's hard to pinpoint what exactly those will be. There will also be penalties and interest, which can be up to 15% of the back taxes owed. There's also the potential for a workers' comp penalty if the client was required to have coverage and didn't obtain a policy, which again can be up to $300 a day for every day that we've gone without coverage in place. It can get costly to be caught out of compliance. So if you have a client in this type of situation, we can help to get them back on track and even possibly avoid some of those major fines and penalties. You can always give us a call and we are more than happy to see if we can help.
Yep, better to do that sooner rather than later, I would imagine. Next question. This might be the last one we have to get to today. What about employees who do not have a Social Security number or who need to update their ITIN?
Yeah, so an employee that has an individual taxpayer identification number or the ITIN and not a social security number, it can get you in some trouble. The ITIN is a tax processing number that's issued by the IRS to someone who is required to have a taxpayer identification number, but they're not eligible or just don't have a social security number. So these ITINs, they don't serve any purpose other than federal tax reporting. Let's say a non-resident alien who is a college student or researcher may receive taxable payments like fellowships or awards. They need to report those to the IRS even though they can't obtain a social security number. That tax ID number, however, does not authorize work in the US, provide legal immigration status, or prove an individual's legal presence in the country. So in January, when filing W-2 with the Social Security Administration, you may receive notices and fines for filing a W-2 for someone that doesn't have a Social Security number. If your employee is authorized to work in the US, they should obtain the Social Security number as soon as possible. And they can apply for one online as well, and then use that Social Security number on all tax documents going forward.
All right, thanks, Mike. That's all the time we have today. If we didn't get to your questions, we'll be sure to follow up with you by email or phone. You'll also receive a PDF copy of this presentation by email later today. You're eligible for CPE credit if you participated in at least 3 of our poll questions, and you'll receive a certificate of completion by email within the next 5 business days. If we can be of any assistance to you or your clients, please don't hesitate to reach out. We'll be happy to help. So once again, thank you for joining us today.